Hi there! In this video, we explain how HMRC's 2.25% unexpected P11D tax charges for directors and employees.
When you need quick access to personal funds, it's tempting to simply transfer money from your company's account. If you plan to pay it back, it feels like an internal, low-risk transaction. I'm your host, representing Fairview Accounting Services. Today, we're breaking down the 2026-27 official rate trap and what it means for your P11D reporting. This chart shows HMRC's official rate of interest. After years of stability at 2.25%, the 2026-27 rate spiked to 3.75%. Beyond this increase, the in-year fixed guarantee is gone. The rate faces quarterly reviews, meaning borrowing costs could shift unexpectedly every 3 months. Casual withdrawals from a director's loan account are no longer a predictable borrowing strategy. They are now a high-stakes compliance risk that requires constant monitoring. By definition, a beneficial loan is any money you borrow from your company at an interest rate lower than HMRC's 3.75% official rate. To simplify administration, HMRC provides a £10,000 de minimis limit. However, many directors mistakenly view this as a tax-free allowance rather than a strict reporting threshold. This threshold is binary. If your total loan balance crosses that line by a single penny for one day, the exemption is void. Once breached, unpaid interest on the entire balance becomes a taxable benefit in kind for the whole year. Repaying the loan quickly to bring the balance back under $10,000 does not remove the liability. Crossing the threshold once locks in your reporting requirements for the period. Uncoordinated cash withdrawals or small expenses charged to the company can trigger a year-long tax obligation from a single temporary overdraft. If you breach the threshold, HMRC uses one of two mathematical methods to determine the value of that taxable benefit. This chart shows the default averaging method. It looks at your balance on April 6th and your balance on the following April 5th, then takes the average of those 2 points, ignoring everything that happened in between. This creates a significant risk if you held a large loan in the middle of the year, but repaid most of it before April. In that case, the averaging method will artificially inflate your tax bill. The alternative precise method tracks your actual daily balance. It calculates the interest on each day the loan was outstanding, which is often more accurate for fluctuating accounts. While more accurate, this method is difficult to manage manually, and you can't always rely on automation. In May 2026, a bug in major payroll software modules caused them to default to the old 2.25% rate, requiring manual verification to avoid underreporting. Blindly trusting software or failing to choose the correct calculation method can result in an unnecessarily high personal tax charge. A beneficial loan triggers tax consequences for both the individual and the business simultaneously. On the first front, the director pays personal income tax on the notional interest. Meanwhile, the company must pay Class 1A national insurance at a rate of 15%. The second front is the Section 455 corporate tax charge, often confused with P11D rules. If the loan isn't repaid within 9 months of the company's year-end, the business faces a separate Section 455 tax, a massive 35.75% charge on the outstanding balance. These combined rules mean a single loan can rapidly drain cash from both your personal income and your company's working capital. You can avoid the P11D benefit in kind charge entirely by ensuring the company formally charges you interest at or above the 3.75% official rate. For this to be valid, the interest must be physically transferred from your personal account to the company's bank account before the tax year ends. A simple journal entry in the accounts is not enough. Because the official rate can now change quarterly, your loan agreements must include dynamic clauses that allow the interest rate to track HMRC's mid-year adjustments. Tax legislation is complex and subject to change. This guide provides general information only, and you should seek tailored professional advice before making financial decisions. To secure your 2026-2027 P11D compliance and protect your cash flow, contact the specialist tax team at Fairview Accounting Services.